3 mistakes are keeping your score under 600 right now. And the worst part, 2 of them you're probably doing on purpose because someone told you they were smart. My name is Claire, and this is the first episode of 0 to 700, a series built specifically for anyone looking at a score under 600 wondering where to start. Not where to start eventually, where to start this week. This is not a video about mindset. This is not a video about believing in yourself. This is a video about the 5-factor FICO scoring model, the exact weight each factor carries, and the 3 mistakes that keep people stuck at 512 for months when the fix was 3 weeks away the whole time. Let's start with the architecture. FICO scores run from 300 to 850. Your score is calculated across 5 factors. Every single factor, FICO publishes the rough weighting publicly. Here's what actually matters. Payment history, approximately 35% of your score. This is the single largest factor. Every on-time payment is a positive mark. Every missed payment is a negative mark that can take years to fully recover from. One 30-day late payment can drop a good score by. Credit utilization, approximately 30%. This is how much of your available revolving credit you're currently using. If you have a $500 limit and you're carrying a $400 balance, your utilization is 80%. That is very bad. Under 30% is the general guidance. Under 10% is where the scoring model rewards you most. We will cover this in depth in episode 2. Length of credit history, approximately 15%. This is the average age of all your accounts. How long your oldest account has been open, how long your newest account has been open, the average across everything. Longer is better. This is also why closing old cards is one of the most expensive mistakes a person with a low score can make. And we're getting to that. Credit mix, approximately 10%. This is whether you have different types of credit cards, installment loans, auto loans, student loans. You don't need every type. You do need more than one type over time. New credit inquiries, approximately 10%. Every time you apply for new credit, a hard inquiry gets placed on your file. Hard inquiries lower your score slightly. Multiple hard inquiries in a short window lower it more. This is the 3rd mistake, and one of the most common. 5 factors. The top 2, payment history and utilization, account for of your score. If you fix only those 2 things, your score moves. Everything else matters, but those are where the leverage is. This is Marcus. And Marcus, very confidently, has been making all 3 of these mistakes simultaneously for the past 18 months. Mistake 1. Closing old cards to clean up your credit. Marcus has 3 credit cards. One is from a store he hasn't shopped at in 4 years. The limit is $300. He closed it 2 months ago. He thought this would help. It did not help. Here's what closing that card actually did. It removed $300 of available credit from his total. His utilization went up. His average account age went down. Both of those factors moved in the wrong direction. Simultaneously, from one action he thought was responsible. Old cards with no annual fee. You leave them open. You put a small recurring charge on them, a streaming subscription, something under $10. You pay it off every month. The account stays active, the age keeps climbing, and the available credit keeps your utilization lower. Mistake 2. Carrying a balance because you think it helps your score. This is perhaps the most expensive myth in personal finance. I hear it constantly. You have to carry a balance to build credit. You do not. This myth has cost people. Carrying a balance does nothing positive for your score. It only costs you interest. The scoring model measures your utilization, the ratio of what you owe to your total limit. Whether that balance is paid in full or carried from month to month does not differentiate. But the interest you pay when you carry, it is real money leaving your pocket for no credit scoring benefit whatsoever. Pay your balance in full every month. Before the statement closes, ideally, because the balance the card reports to the bureaus is the statement balance, not the balance after you pay. Timing matters. Mistake 3. Applying to multiple cards at once to increase your chances. This one is painful because the logic almost makes sense. More applications, higher chance of one approval, except each application generates a hard inquiry, and multiple hard inquiries in a short window signal to the scoring model that you are aggressively seeking credit, which is correlated with financial stress. Your score drops, and you may get denied by all of them anyway, having paid the inquiry cost for nothing. The approach when you're under 600 is one application at a time, with cards that are designed for your score range. Which brings us to the rebuild order. There is an order to rebuilding credit. It's not arbitrary. Each step sets up the next one. Here's the sequence. Step 1. The secured credit card. A secured card requires a deposit, typically $200 to $500, which becomes your credit limit. The deposit is collateral. You are essentially borrowing your own money, but the card reports to the bureaus, just like a regular credit card. The two I point people to at this stage are Capital One Platinum Secured and Chime Credit Builder. Capital One requires a deposit, reports to all three bureaus, has no annual fee, and has a defined graduation path, meaning they review your account after several months of on-time payments and may upgrade you to an unsecured card with your deposit returned. Chime Credit Builder is different. It requires a Chime checking account, there's no deposit, and there's no interest charged. The way it works is your spending is secured by the balance in your Chime account. It reports to all three bureaus as a credit card. What you do with this card, use it for one small recurring charge. Netflix, a tank of gas, something under $30. Pay it in full every month before the statement closes. Do this for 6 months. Your payment history builds. Your utilization stays low. The model notices. Step 2. The Credit Builder Loan. The Credit Builder Loan solves the credit mix problem. The one I reference most is Self Credit Builder. The way Self works, you make monthly payments. Those payments are held in a savings account, and at the end of the term, you receive the money you've paid in. While you're paying, Self reports those payments to the bureaus as an installment loan. You're building savings and building credit at the same time. For someone at 500, adding an installment loan to a credit card is meaningful for the credit mix factor. It also adds another account, reporting on-time payments every month, which compounds the payment history factor. Step 3. Authorized User. If you have a family member or close friend with a credit card in good standing, long account age, low utilization, clean payment history, ask to be added as an authorized user. You don't need to use the card. You don't even need to receive it. The account shows up on your credit report, and the history of that account attaches to your file. This is the fastest short-term score move available to someone under 600. The effect depends entirely on the health of the primary cardholder's account. If the account they add you to has a 10-year history and 0 late payments, that history now lives on your file. Step 4. Low-limit unsecured card. After 6 to 9 months of on-time payments on your secured card and credit builder loan, your score will have moved. At that point, you may qualify for a low-limit unsecured card. Open Sky Secured Visa is worth knowing about at the earlier stage as well. It requires no credit check, which means your inquiry count stays lower, and the $200 minimum deposit is accessible. The unsecured card opens options. You eventually close the secured card, get your deposit back, and your available credit shifts from secured to unsecured. Before we get to the timeline and what Marcus's month 1 looks like, the 500 to 700 roadmap is at cardsmadesimple.com/rebuild. Chapter 1 is free. It's the document version of this video with the utilization math, the product comparison, and the monthly tracking sheet. The link is in the description. Use it. Utilization is simple math with a non-obvious implication. Your utilization ratio is your total balance across all revolving accounts divided by your total credit limit across all revolving accounts. If you have one card with a $500 limit and a $200 balance, utilization is 40%. Above 30%, that drags your score. Same card, same limit. Balance, $45. Utilization, 9%. Under 10%, that is where the scoring model treats you favorably. The non-obvious implication: you do not report zero utilization. Zero utilization can actually flag as no recent activity, which the model treats less favorably than low activity. Keep a small charge. Keep utilization between 1% and 10%. Here is a realistic timeline. This is not a promise. Credit timelines vary by starting point and history. Month 1, open secured card and credit builder loan. First payments post to bureaus. Month 2 to 3, consistent payments. Score typically begins movement as payment history accumulates and utilization is measured. Month 3 to 4, authorized user relationship established. If the primary account is strong, this is when score movement can be more pronounced. Month 6, reassess. Many secured card programs review accounts at the 6-month mark. Month 9 to 12. With consistent behavior across all 4 steps, the 600+ range becomes realistic for someone who started at 490 to 520. Marcus is in month 1. He just opened his Capital One Platinum Secured. He texted me to say the card arrived. He also texted me to say he might use it for a big purchase this weekend, because the limit feels like extra money. Month 1 of Marcus's Rebuild is in the Marcus Builds credit series. Watch it if you want to see what not to do with your new secured card before you've even made one payment. Here's the rebuild order, one more time, clean. 1. Open a secured card. Capital One Platinum Secured or Chime Credit Builder. Use it for one small charge monthly. Pay in full before the statement closes. 2. Add a credit builder loan. Self is the one I point people to. Makes monthly payments. Builds savings simultaneously. 3. Become an authorized user on a strong account if the relationship exists. This is the fastest moving piece. 4. After 6 to 9 months, assess for a low-limit unsecured card. Open Sky is the no-credit check option if you want to avoid the hard inquiry at this stage. The 3 mistakes to stop immediately. Do not close old cards. Do not carry a balance thinking it helps. Do not apply to multiple cards at once. None of this is complicated. All of it requires consistency. The scoring model rewards time and repetition more than any single action. Episode 2 covers the 30% utilization rule in detail, specifically why 30% is the wrong target, what the scoring model actually rewards, and the one timing trick that can show a lower utilization than your statement balance would suggest. It matters more than most people realize. Subscribe now so you get episode 2 the day it drops. If this gave you the rebuild order you've been missing, the like button is right there. The 500 to 700 Roadmap, Chapter 1 free, is at cardsmadesimple.com/rebuild. Link in description. Asterisk this content is for informational purposes only and is not financial advice. Credit card terms, rates,